Hi, I'm Yogin Sabnis, and today I'm going to talk on the myths and misconceptions around real estate investments. In this talk, I want to discuss some points that you may not have noticed or thought about. I do believe that real estate is a wealth creator and a growth asset over the long term. In this regard, it is similar to shares and equity funds. But when people compare the two asset classes, they always speak disparagingly about equity. Generally, the perception is that equities are volatile and risky, and there are fair chances of making losses. Whereas in real estate, if you hold on to it for a long period of time, you're guaranteed to make big money. So let's first see how these two asset classes compare. A few years back, a fund house had come up with an interesting experiment. Just see the picture on the screen. There are two properties which are shown with the prices at which they were bought and sold. Which do you think was the more profitable deal? If you think that it is deal number one, then you're right. Now let's flip the page and see what these properties were. Property number two was the famous sale of a flat in Samudra Mahal building in Worli, Mumbai, which was sold for 40 crores, a flat which was bought for a mere 25 lakhs in 1970. The numbers seem big, don't they? But when you calculate the return, it comes to 12.66%. Not that astronomical. Property number one is actually the BSE stock index, which was formulated at 100 in 1979 and in June 2013 was at 19,500. This works out to a return of 16.76%. So, if the investment in the Samudra Mahal flat was to give equity-like returns, the sale price would have been rupees 135 crores, and that too in a shorter period of time. Other than this, there is also the obvious disadvantage of investing in real estate because of its illiquidity and the big ticket size. Now let us look at the costs involved other than the purchase cost. Typically, when we invest in real estate, there are additional costs. We never take them into consideration when we calculate our returns. Not to speak of additional hassles of keeping the property maintained and the responsibility of paying various dues on time. So apart from the purchasing cost, there are three more types of costs associated with real estate purchase. First is the cost of acquisition. Stamp duty, registration, brokerage, and legal fees constitute almost 10% of the cost of property. And then if you are taking a loan, add the interest cost. Secondly, the maintenance cost, which includes property tax, water and electricity bills. Then for the upkeep of property, you spend towards repairing and painting. Lastly is the cost of taxation. Whenever you sell your property, you either have to pay tax or invest in low interest yielding capital gain bonds. Now, of course, even these investments are restricted to rupees 50 lakhs, which effectively means you pay substantial amount in taxes. The other alternative is to buy another property, which means that you cannot ever cash out. Then there are other hazards which again is given very little or no consideration at all. For example, if you lose your job and are unemployed for a few months, your EMIs continue and are an extra burden. If you are selling, or for that matter, even when you are buying, ascertaining correct market value is difficult. So the price discovery is always a problem. Also, when you are buying a new property from a builder, there is a very real possibility of default from his side. It may be due to the fact that he had not taken requisite permissions or a liquidity crunch for him, or worse, the builder willfully defaults and leaves the project hanging. But for me, the most important part of the conversation really is this. Real estate ticket size is big and it is illiquid. It cannot be sold if money is required urgently. At this juncture, we need to really pause and think, why are we after making more and more money? To fulfill our aspirations and meet our financial goals, isn't it? Let's look at an example of a real estate investor who has property worth crores but very little of anything else. Imagine that now his daughter is seeking admission in a foreign university where the funds required are 50 to 70 lakhs. His smallest investment in real estate is worth 2 crores. Now, what does he do? Sell it? If he does, then he has a problem with the balance money. Also, he incurs capital gains tax. If he doesn't sell, then he has to take a loan, pay interest, and take on more stress. This begs the question of what use is his wealth of crores of rupees? So, in conclusion, the real estate is a growth asset but can be in your portfolio to the extent of 20 to 30%. If you are buying a property which would amount to more than 30% of your assets, it means you better not. Most of us cannot afford and should not attempt to buy real estate as an investment. Remember, there are other less stressful ways to create wealth. If you want to read the detailed article, please click on the link. Do share your thoughts with us either on the YouTube comment section or on the blog section. Thank you for watching.